if I can just flip to the slide. So so the first slide is on the agenda. We're going to be talking through several things on asset liability management for specifically insurance company liabilities. That's where we have very long-term liabilities, and we need to pick a subset of the assets for best matching those liabilities. So if I'll just dive onto the agenda, which I think is the second slide. By the way, guys, there we go. Okay, let's do that. So, okay, perfect. So the agenda, so the first section we're going to be talking about an introduction. What is asset liability management? Second section, we're going to be talking about a specification of the ALM problem to try to define it in kind of mathematical terms. We talk about some early attempts to solve the ALM problem. We look at some current attempts to solve this problem. And then finally, there's a longer section on quantum computing and how this problem is solved using a D-Wave's quantum computer. What is ALM? So asset liability management for life insurance companies and pension funds, where you have very long-term cash flows into the far distant future, where you might have to pay a pension for somebody in up to the next 50 years, perhaps. What we're trying to do is pick a subset of assets which best match those liabilities and also meet a number of criteria. And this problem's been around for hundreds of years, since the first life insurance companies and pension funds. And there's a really nice summary of these principles by Arthur Bailey in 1862. So he kind of first articulated these problems. And the first point that he thought was critical is security of capital. The second point was getting higher yielding assets. The third point he raised is liquidity of assets. So you need a small amount of your assets to manage the day-to-day running of your business, and some of the assets are matching these longer-term requirements. Then he also points out that insurance companies and pension funds can invest in assets which have a higher liquidity premium because they're illiquid. You can invest in them as a large investor, institutional investor, but not as a retail investor. And the final point he made, which is perhaps less relevant, is that the insurance company would want to use those assets as much as possible for its own ends, such as its own office and so forth. So the specification, trying to define that problem in terms of a mathematical specification, we've sort of put in words here, but putting it in words is kind of the first step to writing an equation. So the challenge we're trying to achieve is that we want to minimize the value of our assets, which is the same as maximizing the yield, and that these assets back our liabilities subject to a number of constraints. And those constraints could be specified by your internal management, the regulator, or a credit rating agency, and so forth. And typically these constraints are things around security of capital, sensitivity to interest rate movements, sensitivity to inflation or currency movements, a minimum amount of liquidity, a minimum present value of asset cash flows compared to the liabilities, and a minimum mismatch in any given year. And so those are the main constraints you might be looking at. So this problem has been around for a long time, as I mentioned. So Arthur Bailey's paper in 1862 was where he summarized his principles. It had already been around for a long time by then. But in 1933, we had the president of the Institute of Actuaries stated that we wanted to kind of marry the asset and liabilities together. So that was really, there wasn't really any quantitative approaches even by that time. And that was summarized in this book, A History of British Actuarial Thought, where it was stated that there's basically been no move from Arthur Bailey's principles 70 years earlier. But in 1938, this changed with the Macaulay duration, which is a quantitative method used by a lot of bond fund managers and so forth to match asset and liabilities. So in principle, you would try to match the duration of your liabilities with the duration of your assets. And the duration, in principle, very high level descriptions, it's kind of a weighted average of the cash flows. So if you're matching those durations between assets and liabilities, then you could argue you're broadly matched to a lot of these sensitivities. But there's an improvement on Macaulay's duration approach, and this was produced by Frank Reddington, who came up with an immunization formula. So Frank Reddington, he was voted the greatest actuary of all time, and the reason for that is that he came up with this formula, which is pretty simple, in principle, with the benefit of hindsight. But he stated, if looking at the third bullet point here on this slide, that if you set your assets, the present value of your assets and liabilities, so that they're equal to each other, then any free funds or anything above that is effectively your surplus, so you're kind of ignoring that. So we're only worried about the assets that exactly match our liabilities. And then we apply a tiny change to those assets and liabilities, and we can use Taylor's theorem as an expansion to kind of expand that out. And there's a formula for that here, which has just got the first few terms of Taylor's theorem in the fifth bullet point. And the value of the assets and liabilities disappears because we've already set those equal to one another. And Frank Reddington's discovery was that you could have a satisfactory investment policy by setting the first derivative to zero and the second derivative to be positive. And then you're effectively what he called immunized. So there's a few issues with this approach. I mean, Frank Reddington intended it for interest rates, but it could also be applied to inflation, currency, and other risks that you're exposed to. He noted in his paper there are infinitely many solutions to this problem, and he doesn't say anything about maximizing the yield or minimizing credit risk, and so on. So it's solving part of the problem, but it's not the full problem. And to address some of these other issues, we needed a significant advance in computing power, really, to breach that next stage, to improve on what Frank Reddington did. So what he did was you could effectively do with a pen and paper. But in after the Second World War, there was a huge outbreak of operations research. So leaving the Second World War and moving into industry, all sorts of industries. So factories and so forth would be trying to optimize their production, and insurance companies would be looking to optimize their asset selection. And in principle, you can work through this problem with a simple algorithm using just considering all asset combinations in one after the other. But this takes a kind of infeasibly long amount of time. And these operations research techniques were used to kind of cut down that time. So they would solve that problem relatively quickly by reducing the number of scenarios that would be considered. And these are the scenarios that are perhaps still used today by insurance companies. So they would be looking to apply a sort of operations research techniques like linear programming, non-linear programming, and so forth, using computers to quickly come up with an answer to optimize their asset portfolio. But it might take several minutes to run these sort of operations research type algorithms. And for an insurance company now in across Europe and North America, there's often a requirement to run several 100,000 scenarios on your balance sheet. So even if your optimized asset selection might take, let's say, 5 minutes, if you have to run that 5,000 times, it becomes it's just too long. So it's too fast to get that done properly. So in these current practices, there are effectively two steps to the problem. So the first step is to kind of define the problem in mathematical terms, setting out what you're trying to optimize and various constraints that are included in the problem. And this is done across multi-dimensional space. And then you need an optimization algorithm to solve that. And here on this plot, you're looking at two assets. In practice, you'd have several thousand assets, but in this example, we just have 2 dimensions, 2 assets. So we'd be looking to optimize the point in this space using some algorithm. So first step is to define this shape, and the second step is to kind of optimize, get to the maximum. And whilst this takes, as I mentioned, 5 or so minutes for a a typical a normal computer to get to the next stage, so that we could run a large portfolio many thousands of times, as insurance companies are required to. We really looking at new solutions, and that's where the quantum computer can step into that gap. And with that, I'd like to hand over to Tim to talk through the next stage.
Thank you, James. Now we will consider a quantum computing solution to a real ALM problem. So we will look at the Solvency II matching adjustment problem for reinsurers. This is an optimization problem equivalent to searching for the minimum subset of assets by market value subject to constraints being met. And those constraints are from the regulator that the asset cash flows should be sufficient for the liability cash flows, so sufficiently well matched. And if you get this right, an insurer will be allowed to hold less solvency capital, because the regulator will allow the insurer to say its value of liabilities is similar to this subset of assets. And if you can materially lower that solvency capital, that'd be extremely beneficial to an insurer, and you'll be very popular indeed with the insurer. This problem can be formulated as a quadratic unconstrained binary optimization QUBO model for use in D-Wave's quantum annealing computer. So we'll consider the matching adjust problem with N assets, 2 years of cash flows, and with the UK's Prudential Regulation Authority, the PRA, Test 1 and Test 3 constraints applying. There's a bit of maths here, but it's all pretty straightforward. So if we look at there's the assets with market value V. Its asset cash flows at time t is given by A. The liability cash flows of the insurer is L. And in finance, we like to work out the present value of a future cash flow, and we denote the present value discount factor as D. Capital A will be the present value of accumulated assets up until time t. An asset here is a corporate bond or a government bond. Uppercase L is the present value of accumulated liability cash flows. And then we introduce the qubit, xi. So it's going to be 0 if the asset is not included in the subset, or 1 if the asset is included. This then allows us to formulate the constraints. And the first one, PRA test 1, is such that the shortfall in accumulated asset cash flows cannot be more than 3% of the present value of liabilities. And that constraint applies at each time t, so perhaps each year. So this is in fact many constraints. PRA test 3 is just requiring that the overall asset cash flows are larger than the liability cash flows. And then at the bottom there is the objective function we're seeking to minimize subject to constraints, and that is the combined market value of the chosen subset of assets. So it's the sum of xi, xv. You can see in those constraints that they are something greater than something else, an inequality. So what we seek to do is make those an equality, something equal to 0. So we do that by moving everything over to one side and introducing slack variables. The slack variables contain qubits, and effectively there's a qubit for each power of 2, and that allows effectively an integer to be added to left hand side. And we know the upper and lower bound of that, what that integer could be. So we know the number of qubits to be added. There's a similar formula for PRA test 1, and if you're interested, there's the relevant paper shows its formulation. And it's shown on the last slide. So the objective function to minimize becomes the following. On the left is the subset of assets, its market value. In the middle is PRA test 1. On the right is PRA test 3. If you look at the right hand side, it's got that equality equal to 0 squared. And if something squared is minimized when that something is 0, so it's minimized when the constraint is met. And if the constraint is not met, then we want to penalize that, which is why we multiply that by a penalty factor, P3. So then this is in a form which can be converted easily to a QUBO matrix, ready for use in a quantum annealing computer. Just a word on the number of qubits is given by the formula on the screen there. In practice, it's pretty practical to use the same number of slack variables for each constraint, and that's probably realistic given that every time I add slack variable, it's adding an extra power of 2, so it's going to be a pretty large number pretty quickly. So with that simplified practical approach, if an insurer has about 3,000 assets, 50 years of projection, and liabilities of about £50 billion or dollars, then the number of qubits is likely to be perhaps just under 4,000. So that's quite exciting. It's sort of in the range of what is possible. Just a word on the fraction of the asset, which is what we would ideally like to be able to do. Here we're doing the binary model, so assets either included or not. We could, of course, split an asset into 2 parts and assign a qubit to each bit. Or there's the discrete model, or as we learned earlier today, there's now a continuous version, and that is hugely interesting for the ALM problem. Okay, we'll just finish on a quick worked example. So if we consider a case of 5 assets, 5 years of cash flows, and only PRA test 3 applying, then the inputs to the problem are shown there. There's risk-free spots rates, from which you can derive the discount factors. There's liability cash flows, asset cash flows, and asset market values. We choose the penalty factor to be 10, but that we can come back to that later and choose another number if we wish to. So from those inputs, we can derive the objective function. It turns out that 6 qubits are needed in this case, and that form at the bottom can be easily converted into a QV matrix for the annealer. So we've got 5 assets here. So there's 2 to the power of 5. That's 32 possible subsets. So we can consider this in a classical way using a spreadsheet. So at the bottom row, if we included all 5 assets, then the market value would be a bit too high, but the constraints would be met. If we only included 1 or 2 assets, like some of the top rows, the market value would be low, which is great, but the constraint wouldn't be met. There wouldn't be enough cash flows. So in this case, there's only 3 subsets pass a constraint, and the penultimate one is the optimal case, and that has the first 4 assets only and not the 5th one. So we know the solution we're looking at. Now we can see what we expect from a quantum annealer. There's the 5 assets and the 6 slack variables, so there's 11 qubits. So that's 2 to the power 11, 2048 possible subsets. So again, a very manageable number. And from this, we see that the optimal case is again the first 4 assets. The 5th one's not needed, and the slack variables can be discarded at this point. So this is encouraging. It suggests that our formulation of the QUBO is about right. So then we put this into the D-Wave annealer, and straight away, first time, the exact result came out as we hoped in an instant. So that is very encouraging. So to conclude, there is a purpose to this. If you can find the optimal subset of assets, this will be beneficial to an insurer's solvency position. That will be good for shareholders. And over time, this will be beneficial to real people who may be in the UK, for example, on the brink of retirement and may wish to buy an annuity, and their premium may be lower. So this does have a real purpose. This type of solution goes beyond insurance. If you think of, say, the cost of decommissioning a nuclear power station, this has liabilities which are very large in a distant future. So you want to think, what are the optimal assets to hold now to cover those? And just to sort of dream about the future, if it were possible to consider the whole investable universe of assets in a continuous way and solve this in a fraction of a second, that would be remarkable for insurers. So I'd just like to finish by thanking the Institute and Faculty of Actuaries in the UK, who are very supportive and excellent group of actuaries involved. And finally, thank you to D-Wave for the incredible science, but also making these tools accessible to us and easy to use. So, thank you.